let's talk about DLT.
Targeting the crypto users, future cash flow. Payment today in the US is pretty dark. How more and more blockchain goes beyond, and we're going to have my financial analyst who's going to jump in me to trade
Bitcoin halving, expectations versus reality. Emmanuel, hello, and thank you so much again.
Good to be here again.
Exactly. So the listeners were like really doped about what we spoke about last time, and they really enjoyed the conversation. So we are here today. We're going to delve deeper into institutional blockchain, how it works, and also more into technical side and aspect of it. So let's start. Maybe 1-2 minutes on those two topics. If I tell you BUIDL, what you are going to say?
A drop in the bucket, but a non-negligible drop, right? Drop in the bucket because you're looking at an instrument which is targeting the crypto users, right? Which in the broader context of BlackRock is a negligible revenue contributor. Even at today's AUM rounded to 20 billion, keep in mind this is 15 bips management fee. So from that standpoint, drop in the bucket, but a non-negligible drop in the bucket because it's BlackRock.
Yes, sir.
Right?
Yes.
Because you have Benji coming from Franklin Templeton, you have a few others, you have institutions recognizing crypto as its own asset class, deserving allocation with passive mandates. And you can totally see from there two directions, right? You can see solutions catering to the crypto crowd. BUIDL, Benji are examples. You can see crypto products, similar to their Bitcoin ETF that would effectively bring in crypto to the masses. But I think you're also going to see an evolution where we're going to move away from plain passive mandates,
yes,
into more active mandates providing crypto exposure. And then we're going to move away from your vanilla, here are some treasuries I'm moving on chain, right, for you crypto crowd to get your 5% yield. We're going to see that blockchain enablement in the back end of much bigger funds.
Nice.
That are not targeting just crypto users, but are just targeting clients, period.
Yes, sir. Bitcoin halving, expectations versus reality.
So Bitcoin halving is a fascinating topic. And fascinating, I'll qualify the following. First, people make a huge deal out of it in terms of, and that's going to trigger a rally, this, and that. But if you go back to very basic finance, right? Today's price is a discounted value of future cash flows, right? Future cash flows are influenced by information, but information which is known in magnitude and time should already be fully incorporated into today's price. Unless you're saying that market is inefficient, right? And therefore that halving has an effect. So there is one side there where I see that and I'm like, okay, this is kind of like a nothing burger, really, right? We already know it's going to happen. We know when it's going to happen. We know the exact magnitude of that change. It should be reflected in the price. And I think this is probably where a number of folks on the DGen side of things were maybe a bit surprised, where we didn't really see a rally, but I don't think there was reason to expect a rally anyway.
Yes,
right?
yes.
Now, there is another part which is very interesting, happening, I would say, more behind the scenes at an infrastructure level. As you have more and more, your fixed cost of operating as a Bitcoin miner, right? That fixed cost is not drastically changing. And for sure, your cost is not halving within every period that Bitcoin is halving. And so for a lot of miners, your fixed costs at some point are going to become unsustainable, bear a crazy price in Bitcoin. And so what is happening today, which I think a lot of folks are not realizing, is a number of Bitcoin miners are effectively getting absorbed by private equity roll-ups. Private equity roll-ups who are coming from regions with very significant balance sheet and very significant fixed cost advantage. Either energy is very cheap or hardware is very cheap or both. Right?
Nice.
And when you see a trend like that, this is reminiscent of what happened with oil,
Okay.
right? Oil extractors who had fixed costs that at certain price for the oil barrel, they couldn't justify operating.
Yep.
And they got gobbled up by notably some sovereign oil producers, right, in the Middle East. And then you have that very interesting power play dynamic where you could see huge PE roll-ups effectively having a controlling market share of the miners and gaining influence on the Bitcoin price by virtue of that, right?
Yeah.
And looking at Bitcoin in a similar way to how they would be looking at oil.
Interesting.
So that's where I find that Bitcoin halving to be fascinating.
Yep. Yes, sir. Now let's move now into pure tokenization and situation.
Okay. Enough of the chit chat.
Exactly. I was reading I was reading an article from Ondo, and they were talking about a new perspective. Actually, it's not a new perspective. I believe it's about time to talk about it. Tokenization as money generating machine rather than being just like an efficiency problem solver. We always talk about DLT, for example, in clearing and settlement being like saving transaction cost, couple basis points on each transaction. However, it's rarely we see people talking about tokenization as money generating machine. What's your intake? I know that you have a lot to say about it, so
I'm very opinionated on the matter. But let me first take a step back.
Yep.
Right? Institutions,
Mm-hmm.
enterprises for that matters, not just institutions, are driven by profit generation.
Yes, sir.
Right? And are driven by margin preservation or margin increase. So when you think about an enterprise eagerness to adopt a new software, a new technology, a new infrastructure, decisions will always be much faster when they are about profit rather than cost savings, right?
Mm-hmm.
So that's the first point I want to make, right? And therefore, when you think of blockchain, right, I agree with that statement from Ondo, and a few others have that comment, which is blockchain goes beyond cost savings. Blockchain goes into revenue generation, into revenue increase, into profit increase, into margin increase. But this is less talked about. And part of why I think this is less talked about is because it requires a much deeper knowledge of finance to really be able to retrace the whole thing. Because to say, oh, it's going to be a profit generating because boom, now you have new buyers, they are the crypto degens. Drop in the bucket. Nobody cares.
Yes.
That aspect of cost savings versus profit generation, where you need to go much deeper into finance, not specific to blockchain. You go back 5 to 10 years ago, we had the exact same situation with artificial intelligence.
Yep.
When artificial intelligence started popping up on Wall Street, the first argument that were being pushed were cost-saving arguments.
Yes.
Quants inside quant funds would be able to develop strategies faster. You would be able to run your risk simulations quicker. You would be able to recalibrate better. It was all around cost savings from the quants, the desk strats, the core developers, the strategists. The uptake was actually not very good.
Yep.
Because there was like, okay, but reducing cost on the quant because they push a strategy a bit faster is not a drastically different unit economics. But it took time for open source libraries to mature, for data sets to mature, become more available, for the skill set of quants to get up to speed with effectively the newer applied math, right? And then people started realizing that it was really about profit, not purely about cost savings, right? They also started realizing that the two are typically intertwined. Okay, so I just wanted to give that context high level to make clear that my view on blockchain as profit generation versus cost saver applies beyond blockchain to just the adoption of new technologies into enterprise. Right?
Yeah.
Now, going into the specifics, I'm going to start talking about why I think the two are intertwined. So I'm going to take your example of clearing and settlement.
Yep.
People say, okay, great, we're compressing clearing and settlement costs by 80%. So that's a cost reduction. Yes. However, there are very significant asset classes where the clearing and settlement is actually so long that the cost involved is not just the pure cost of processing the transaction, it's also the cash immobilization while your transaction clear and settles.
Yep.
Right? For asset classes, notably private markets are a prime example, right? Private credit comes to mind. When you're looking at 1 month to 6 months to clear and settle, when you're counting the clearing and settlement cost in points, 2% to 7% of principal value, right? Lost to clearing and settlement. When you're looking at cash being immobilized for that 1 month to 6 months, where you are not earning money market and money market is at 5%, what happens is your ability to scale the funds in question start getting constrained. Because if your fund grows too big, the money you're leaving on the table is just no longer acceptable because your incremental margin becomes negative. So suddenly that compression in clearing and settlement is not just about, oh, I'm saving 10 million bucks, I'm saving 50 million bucks. No, it's about bringing the time taken by those financial operations. It's about reducing cash immobilization so much that you could actually double your AUM, triple your AUM, 10x your AUM. And suddenly that's actually about profit. It's first and foremost about profit. So this is, to me, a very key aspect. Same goes into, for example, taking another example, payment. Payment today in the US is pretty darn efficient. You look at credit cards, you look at wallet-to-wallet transactions, for example, through PayPal, you look at companies using FedWire or using ACH, even Swift or cross-border. It's pretty efficient. Yes, things could take time. For example, a wire, right, is going to be like 3 days, but you can move huge amounts and it's not that expensive. So if I show up and I tell you, okay, now your wire, instead of typically taking 3 days, it's going to take an hour. I'm reducing cost. Okay, am I increasing profit? Not clear either, right?
Yeah.
Wires have very specific use cases.
Yeah.
But now let's start talking about not so much the payment is going to happen faster. Let's talk about the payment programmability aspect. The ability to have very complex logics between partially or fully fragmented applications and workflows in complete compliance with an extremely high degree of automation. You are no longer talking about cost saving. You're talking about profit generation.
Here, when we're talking about the harmony between the applications and the siloed markets, are we talking about like acquire, issuer, and the card network, or it's something completely different? Just to make it more clear.
So no, that's one layer. Right? Like, so today, take a big payment firm, like a PSP, like Fiserv. In the background of Fiserv products are 13 different processors that are not integrated with one another. Upgrading the technology of those processors to have complete integration, complete interoperability is extremely expensive. Part of that is these are code bases that are very old, right, that are not necessarily using much open source components. Right? So there is a massive lift that needs to be taken up internally to get up to speed. Then there is the what if something goes wrong in a corner case. So that's one example. There is another example, which is the integration between payment solutions and, for example, FP&A teams or treasury teams inside corporations. The ability to have a much higher degree of automation in account reconciliation. The ability to have a much higher degree of automation and therefore a much better planning in your supply chain finance. The first line of thought is to say, okay, today I have 100 people to do that. If I can automate, I will only need 10 people. But when you look at the overall cost of your account reconciliation, when you look at the overall cost of your supply chain finance, the 90 people on the headcount is not your main cost. Your main cost is the time it takes for the overall financial transaction to complete, to be reconciled, to get resolved when there is an error happening. It's all these delays where cash is immobilized, etc., that are really hindering your cost. That's really where, to me, this is key. There is that blur line between saving costs, and at some point, that saving cost is actually a driver of huge profit growth, right? And a few aspects. And none of this is about, it's finding a pocket of new users that just happen to generate so much revenue. It's more about your user base, your workflows. The fact that they work well doesn't mean that they work efficiently.
Yes.
And if something doesn't work efficiently, your ability to scale to the magnitude your clients are asking, or your prospective clients are asking, could be significantly reduced. I'll mention one last thing, which is, I think, very key in finance, which is your operating cost in financial workflows is a non-linear function of the size at which that workflow is running. For me to trade $1 billion in structured credit, I need to finance my positions, right? Let's say it costs 2%. If I 10x my structured credit portfolio, I no longer get charged 2%. I probably get charged 4%, 5% on the margin. This is also where you see those very critical aspects around the interplay between technology enablement, cost compression, and basically driving profit.
Yep. I just want to plug in here, like, quick question. You see, we always talk about this. Is this a startup game, or like JP Morgan, Goldman Sachs, their Onyx game? What do you think, like, here?
Both.
Okay.
Right. Both for a few reasons. First, financial institutions will not go away.
Yeah, definitely.
Right. The narrative of we're going to replace the banks and we're going to replace TradFi is a cute narrative that has no ground.
Exactly. It's utopia, but like
it is a complete utopia. Yeah. So financial institutions are here to stay. Will they have to change by virtue of this extremely powerful technology? Yes, but they will remain in place. So some of them could disappear, some of them could get absorbed, and some of them will continue to thrive. So that's the first point I want to make. Now, could they do everything on their own? Well, we've already seen historically that the answer is no.
Yeah.
Right? Financial institutions have never been fast moving and have typically not been fast at onboarding new technologies. It's not specific to financial institutions. I think it's specific to enterprises in general. It's more pronounced in financial institutions because they are regulated. And you see something similar in healthcare, by the way, for the same reason. So startups also have a role to play. Now, where I think startups need to be both cautious and very deliberate is in, of course, their product and go-to-market strategy. Products that are effectively too much at the front end might work in the short term, in my view, may not be defensible in the long term because they are not owning enough of the relationship. They are not owning enough of the flow of funds, the flow of assets. At some point, right, they could get effectively acquired. Go-to-market is also relevant because in finance, and I think that's actually specific to finance, most workflows are basically financial transactions. They are multi-party transactions. In most of those multi-party transactions, one side benefits from inefficiencies. The other side suffers from inefficiencies.
I see. Yeah.
Right? So you take, for example, the example I was going just before. You take a private asset. Take, for example, a syndicated loan. It takes a month to 6 months to clear and settle. The bank is benefiting from that protracted clearing and settlement time, and is benefiting from the inefficiencies in the system, generating a higher cost of clearing and settlement, typically a bigger bid ask, etc. Right? The asset manager is negatively impacted by it. If I'm a startup and I say I'm going to make instantaneous clearing and settlement, and well, the first thing I do is to go to Goldman Sachs or JP Morgan. Failure, complete failure.
Yep.
They don't want efficiency on that.
Yep.
Right? You need to go to an asset manager. So this is, I think, the challenge for the startups, right? Actually, there's a second layer to that go-to-market challenge, which is most startups want to put points on the board quickly. So they want to show you that they're getting a pipeline with a lot of logos and that the sales cycles are not too long. So they're typically going to go to the tail of, for example, asset managers. And they're going to show up after a year and they're going to tell you, look, I have 12 asset managers who are my clients. And I couldn't care less. because the tail of asset managers, their ability to drive technology adoption
Is not measured.
when you're touching asset and flow transactions, zero.
Yeah.
Right. And so that's the other difficulty, which is you need to be able to go to mid-market or effectively large financial firms. The sales cycle is going to take longer. The requirements on product are going to be higher, right? The way you put points on the board is not by showing a bunch of logos, it's by showing how you're working with one really relevant logo and penetrating the org at a senior level to understand the internal politics that could oppose your integration, how you're going to go and have them ramp up your usage or the distribution of your product. Right?
Yes.
So I really think it's going to be that duality.
Nice.
Some institutions do, I think, a very good job. I mean, JP Morgan has been doing a great job with Onyx. I disagree on the closed source approach, which is part of their blockchain approach. I'm very much convinced that open source will be the way forward, but they've done a great job, right?
Yes.
Now, are they working on their own? No, they are engaging with startups for certain aspects,
Yep.
right? And some will be acquired and some will actually be replaced by JP Morgan homegrown solutions. And some will thrive into a partnership with that bank and then other big banks and other big firms.